You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Hello, this is Chad Carnes, Chief Market Strategist at ETFguide.com. Thanks for joining me today as I look at the good, the bad, and the ugly in VIX trading. Over the past few months, the VIX has provided us with some great trading opportunities, but the volatility-linked exchange-traded products remain a risky venture. We prefer using VIX options to hedge rather than hit-and-miss exchange-traded products, and I'll take you through some of the reasons now. The VIX has helped us spot some short-term market tops in the past, providing great volatility trade setups, and can be taken advantage of using traditional options or the newer VIX exchange-traded products. But there are some nuances in trading the VIX that need to be addressed before just jumping into a volatility investment. Some of them are good, some bad, and some are really ugly. So first, let's look at some of the good of the VIX. One great aspect of trading the VIX is there are a lot of different ways to capitalize on potential opportunities for investors, traders, and hedgers alike. The first is the fear trade. You can trade the S&P 500 based on the VIX signals. Typically, the VIX will behave inversely to the S&P 500. When the VIX is up, the S&P or the SPY, which is the S&P ETF, is usually down, and vice versa. But it's not always the case. There are examples when both the VIX and the markets are up or down together. A majority of the time, though, especially on days with big market moves, they move in opposite directions. This is the reason the VIX is often referred to as the fear trade, as it typically rises when markets sell off, and it rises greatly when markets sell off in a panic. The more traditional way to trade the VIX is using old-fashioned futures or option strategies. This would likely provide the most correlated trade with volatility, allow for direct, measurable, and fine-tuned strategies. Futures and options are usually considered risky, can be convoluted, and are definitely not for all investors, though. This strategy would likely work best for a longer-term sophisticated investor looking to hedge his or her portfolio. And finally, what I like to call the adaptation. The best part about the VIX today is there are numerous exchange-traded products that track volatility and allow individual investors to take advantage or hedge moves in future volatility expectations. But these also come with a lot of baggage that can kill an investment if they're not properly understood or executed, and that will be the focus of the remainder of this video. Each year there's more and more volatility exchange-traded products being added, and today there's over 15 different choices. The major differences between them all typically involve which exchanges they trade on, which banks control their underlying assets, their fund structures, and the amount of leverage utilized in their tracking. So some bad things about these VIX ETFs. And one of the best ways to look at these nuances is through charts. And this chart that I've had up is just the simple VIX. Now I'll move to another chart that shows the tickers that are shown in the upper left corner, which is the VIX, the VIXI, and the VIIX. The bad thing about all these ETPs is they don't track the popular underlying VIX index all that well, which this chart helps to show. The VIXI and the VIIX, which is the velocity shares version of the exchange traded product, are shown, and they pretty much track each other. They're the dark colors in blue, and the VIX is in red. And you can see that since the beginning of 2013, if you would have held the VIXI or the VIIX, you would have lost more than just holding the VIX alone, and you'd be underperforming by about 4%. Over short periods of time, these perform very similar to the VIX. As you can see in the chart, on certain days they're very, very similar, but there will be hiccups along the way when one will rise or fall, and the other one, the VIX itself, won't. Unfortunately, this seems like something that traders of volatility exchange traded products are going to have to accept over the short run until a better alternative is created. Now it starts to get ugly, and I'll show you why. A 4% tracking error over the course of a few weeks, it can be acceptable given the kind of volatility the VIX index has, but that amount increases greatly as time goes on. So moving back another year to the beginning of 2012, the difference between these exchange traded products after fees and other nuances associated with their inner workings and structure compared to the VIX is a huge 41% difference now. So it's ballooned 10 times when you add another year into the equation. So back to the original chart, a 4% difference over a 2-month period grows to an over 41% difference in a year and 2 months. The VIX is down 44% here since the beginning of 2012, but these exchange traded products are down a whopping 84% plus in that same period. That is pretty much unacceptable, and it's a major warning for investors to not hold these products longer than a few weeks. But it gets even worse. The levered VIX products, just like the other levered exchange traded products available to investors, also have the well-known time decay issue to add to their tracking error. The chart on the screen here, the velocity shares 2-time levered VIX ETN, the TVIX, is shown and puts this tracking error and time decay into perspective with an even larger 55% difference since the beginning of 2012. If you would have bought the TVIX on January 1st of 2012, you would have lost 99% of its value. Whereas if you would have bought the VIX, you would have only lost 44%. So for volatility trading, we actually prefer the pure option play, as we suggested in our January ETF Profit Strategy newsletter, which we published on December 17th when the VIX was trading at around 16. It was a good time to buy protection, and we said the VIX has refused to spend much time below the 15 level, providing a solid support and buying area for VIX bulls. This was in this area right here, around 16. As it approached that level, buying front month in the money calls is a good trade. We like going along the VIX January 14th call options at $271 a contract. So we were buying VIX calls at $271 when the VIX was trading around 16 in mid-December. And then you can see what happened, by the end of the year, December 31st. Those calls went up over 100%. To $560 each, where we advised taking profits as the technicals warned us of a short-term top, which we discussed in our twice weekly published technical forecast. The VIX exchange traded products can be used to trade volatility over short periods of time, but we stress not to hold them any longer than a few weeks max. They're made strictly for trading and not for longer-term portfolio holdings or hedging. Options remain the better way to hedge a portfolio with volatility protection. Thanks for joining me today, and please check out some of our other videos on our YouTube channel, as well as our many other investment tools and research over at etfguide.com. We also are on Twitter if you'd like to follow us, and we offer a monthly newsletter, weekly ETF picks, and I also do a few times a week technical forecast. Thanks.